If you hold assets that are sensitive to geopolitical risk, currency stability, or resource scarcity, you need to understand what's happening right now. I'm not here to sell you fear. I'm here to walk you through a situation that has real implications for how capital moves, how governments think about strategic security, and how markets may reprice certain assets in the months ahead. The conversation around Greenland has returned. But this time, it's not a curiosity. It's not a headline that fades in 48 hours. This time, there are economic forces, strategic pressures, and financial consequences that matter to you as an investor. Whether you already hold commodities, precious metals, defense stocks, or energy assets, or whether you're sitting in cash trying to decide what comes next, this situation deserves your attention, not because it's dramatic, but because it's structural. Let me explain what's actually happening, why it matters, and what it means for disciplined investors who think in years, not days. In early 2025, geopolitical tensions around Greenland intensified in ways that go beyond rhetoric. The United States government has publicly discussed the strategic importance of the island. Multiple officials have stated that controlling access to Greenland's resources, Arctic shipping lanes, and military positioning is a national security priority. This isn't new in concept, but the urgency is new. The language is new. And the economic context surrounding this conversation is completely different from anything we've seen in the past 2 decades. Greenland sits at the intersection of 3 massive global trends. First, the race for critical minerals needed for technology, defense systems, and energy infrastructure. Second, the opening of Arctic trade routes as ice recedes, which shortens shipping times between Asia and Europe by thousands of miles. Third, the militarization of the Arctic by both China and Russia, who have been expanding their presence in the region for years. These aren't speculative risks. These are observable, measurable realities. China has labeled itself a near-Arctic state, despite being over 900 miles away from the Arctic Circle. Russia has rebuilt Soviet-era military bases along its northern coast. Both nations have invested billions into Arctic infrastructure, icebreaker fleets, and resource extraction operations. Now ask yourself, if you're the United States and you see 2 rival powers positioning themselves to control the world's last frontier of untapped resources and strategic shipping lanes, what do? You respond. And that response has financial consequences. When people hear about Greenland, they think it's about territory. They think it's about nationalism or symbolic posturing. And they miss the underlying economic forces that make this moment different. Greenland contains some of the world's largest deposits of rare earth elements. These are the materials required to build semiconductors, electric vehicle batteries, wind turbines, and advanced weapon systems. Right now, China controls approximately 70% of global rare earth production. That's not a competitive advantage. That's a choke point. If you're a Western government trying to secure your technology supply chain, reduce dependence on Chinese materials, and ensure your defense industry can operate independently, Greenland becomes strategically irreplaceable. Beyond minerals, there's energy. Greenland holds potential oil and gas reserves that have barely been explored. As Europe seeks alternatives to Russian energy and as global demand continues to rise, these resources gain value. Not today, not this quarter, but over the next decade. Then there's the Arctic itself. As polar ice melts, new shipping routes open. The Northern Sea route, which runs along Russia's Arctic coast, can cut transit time from Asia to Europe by up to 40% compared to the Suez Canal. Whoever controls access to these routes controls a significant portion of global trade flow. Most investors see headlines about Greenland and think it's noise. What they should see is a signal about resource competition, supply chain realignment, and the reorganization of global trade infrastructure. This is not a distraction. This is the early stage of a multi-decade shift in how the world's most powerful nations secure their economic futures. Here's the part that most people get backward. On the surface, it seems like China and Russia would oppose any U.S. interest in Greenland, and publicly they do. But strategically, they may actually benefit from the United States attempting to acquire or exert control over the island. Why? Because it forces the United States to commit resources, political capital, and strategic focus to a region that is extraordinarily expensive to develop and defend. Greenland is not a profitable territory. It's a cost center. It requires infrastructure investment, military presence, and ongoing financial support to Denmark, which currently governs the island. If the United States moves forward with any formal arrangement regarding Greenland, it ties up American capital and attention in the Arctic. That's capital and attention not being spent in the South China Sea, the Middle East, or Eastern Europe. From China's perspective, an American focus on Greenland could relieve pressure in the Indo-Pacific. From Russia's perspective, it validates the importance of the Arctic and justifies their own military buildup in the region, which they've been pursuing for years without significant Western response. There's also the currency dimension. Any major U.S. expenditure related to Greenland would likely require either increased borrowing or reallocation of existing budget resources. In an environment where the U.S. national debt exceeds $36 trillion and interest payments on that debt are approaching $1 trillion annually, every new commitment strains the fiscal position of the country. China and Russia both hold significant U.S. dollar reserves. They've both been slowly diversifying away from the dollar over the past decade. If U.S. fiscal conditions deteriorate further, the dollar weakens, and inflation pressures return, both nations benefit from holding hard assets, commodities, and gold, all of which tend to appreciate when confidence in fiat currencies declines. So when you ask why China and Russia might want the U.S. to pursue Greenland, the answer isn't about the island itself. It's about the strategic distraction, the fiscal cost, and the potential weakening of U.S. financial dominance that could result from overextension. Let's zoom out, because none of this happens in a vacuum. The reason the Greenland situation matters to investors right now is because of where we are in the economic cycle. We are in the late stage of a debt supercycle. Global debt, both public and private, has expanded faster than economic growth for more than a decade. Central banks responded to the 2008 financial crisis, the 2020 pandemic, and ongoing economic fragility by printing money, suppressing interest rates, and inflating asset prices. That worked, until it didn't. Inflation returned in 2021 and forced central banks to raise rates aggressively. Higher rates exposed the fragility of over-leveraged economies. We've seen bank failures, real estate stress, and increasing defaults in corporate credit markets. Now central banks are caught. If they keep rates high, they risk recession and financial instability. If they cut rates too quickly, they risk reigniting inflation. This is not an easy problem to solve, and it's happening while governments continue to run deficits that require constant refinancing. In this environment, geopolitical risk matters more. When debt levels are manageable and economic growth is strong, markets can absorb shocks. When debt is extreme and growth is weak, every shock gets amplified. Greenland is one of those shocks. It's a reminder that the world is reorganizing around resource security, not just financial efficiency, and that reorganization has costs. If you're holding equities in sectors tied to defense, aerospace, critical minerals, or Arctic infrastructure, this environment is constructive. Governments will spend, contracts will be awarded. Companies positioned in rare earth processing, military technology, and energy exploration will see increased demand. But that doesn't mean you chase stocks blindly. Valuations matter. Timing matters. The market may already be pricing in some of this tailwind. Your job is to understand which companies have actual exposure to these themes and which are just riding the narrative. If you're holding commodities or precious metals, the Greenland situation reinforces the long-term thesis. Resource nationalism is accelerating. Supply chains are fragmenting. Countries are prioritizing security over cost. That creates upward pressure on the price of scarce materials. Gold, silver, copper, lithium, uranium. These are not speculative bets. These are strategic assets in a world where trust in paper currencies is eroding and physical resources are being weaponized. If you're holding cash or government bonds, you need to understand the risk. Bonds are sensitive to inflation and fiscal instability. If the United States continues to expand its strategic commitments without a clear plan to fund them, bond markets will eventually demand higher yields. That means lower bond prices. That means losses for holders. Cash is safe in nominal terms, but dangerous in real terms. If inflation remains elevated or returns after a brief pause, the purchasing power of your cash declines. You're not losing dollars. You're losing what those dollars can buy. This is why asset allocation matters. This is why diversification matters. This is why understanding the macro environment is not optional for serious investors. We've been here before. Not with Greenland specifically, but with moments where geopolitical competition triggered resource races and currency instability. In the 1970s, the U.S. faced fiscal pressure from the Vietnam War, rising oil prices from OPEC, and the collapse of the Bretton Woods monetary system. The result was stagflation, low growth, high inflation, and a decade of poor performance for traditional stocks and bonds. What worked? Commodities, energy, gold. Real assets outperformed financial assets because the underlying structure of the economy was shifting. In the early 2000s, China's rise created a commodity supercycle. As China industrialized and built infrastructure at unprecedented scale, demand for oil, copper, steel, and rare materials surged. Investors who understood that structural shift made significant returns. Today, we're seeing another structural shift. It's not about one country industrializing. It's about multiple powers competing for control over the resources and trade routes that will define the next 50 years. History doesn't repeat, but it rhymes. And the rhyme right now sounds a lot like the early stages of a prolonged period where hard assets, strategic commodities, and resource-linked equities outperform passive index funds and government debt. Let me be very clear about what this is not. This is not a signal to panic. This is not a reason to sell everything and hide in a bunker. This is absolutely not an invitation to speculate recklessly on mining stocks, penny commodities, or leveraged ETFs. Do not react emotionally. The worst investment decisions are made in moments of fear or greed. If you don't understand an asset, don't buy it. If you can't explain why you own something, you shouldn't own it. Do not chase headlines. The Greenland story will cycle in and out of the news. Some days it will seem urgent, other days it will disappear. Your investment strategy should not change based on what's trending on social media or cable news. Do not over-leverage. Margin, options, and high-risk derivatives are tools for professionals with specific strategies and risk controls. They are not tools for individuals trying to get rich quickly. Leverage amplifies losses just as much as gains. And in volatile markets, it can wipe you out before you have a chance to recover. Do not blindly follow influencers or commentators who promise certainty. No one knows exactly how this plays out. No one can tell you the exact price target for gold, oil, or rare earth stocks. Anyone who speaks with absolute confidence is either dishonest or delusional. What you should do is stay informed, educate yourself, understand the forces at play, build a diversified portfolio that reflects your risk tolerance, time horizon, and financial goals, and most importantly, remain patient. If you already own gold, silver, commodities, or resource-related equities, the Greenland situation reinforces your thesis. It doesn't mean you are right. It means the probabilities are shifting in a direction that supports long-term value in hard assets. But don't let confirmation bias cloud your judgment. Just because the macro environment is supportive doesn't mean every position in your portfolio is correct. Review your holdings. Make sure you understand what you own and why. Make sure your position sizes are appropriate. If you've seen significant gains, consider whether it's time to rebalance. Taking some profit off the table is not a sign of weakness. It's a sign of discipline. No one ever went broke locking in gains and managing risk. If you haven't seen gains yet, don't assume you're wrong. Markets can remain irrational longer than you can remain solvent, but they also eventually reprice based on fundamentals. If your thesis is sound and your time horizon is long, patience is your advantage. The key is to avoid complacency. Holding an asset is not a passive activity. It requires ongoing evaluation, risk management, and the willingness to adjust when conditions change. If you're sitting in cash, bonds, or traditional equity index funds, the question you need to ask is, does my portfolio reflect the world as it is today, or the world as it was 5 years ago? The financial system is changing. Monetary policy is constrained. Fiscal deficits are expanding. Geopolitical tensions are rising. Resource competition is intensifying. These are not temporary disruptions. These are structural trends. That doesn't mean you need to abandon traditional investments. It means you need to consider whether your allocation accounts for inflation risk, currency risk, and the possibility that the next decade looks very different from the last. A thoughtful allocation might include exposure to commodities, precious metals, energy, or resource equities. It might include international diversification to reduce dependence on any single currency or government. It might include real estate or other real assets that tend to hold value during inflationary periods. But whatever you do it deliberately. Do it based on research and understanding, not fear or hype. And do it in a way that allows you to sleep at night. The worst outcome is not being wrong. The worst outcome is being unprepared. Let's talk about the elephant in the room. The United States government is carrying a debt load that is historically unprecedented in peacetime. Interest payments on that debt now exceed defense spending. Every percentage point increase in interest rates adds hundreds of billions to the annual budget deficit. This creates a trap. The government needs low interest rates to manage its debt, but low interest rates encourage borrowing, inflate asset bubbles, and can reignite inflation. The Federal Reserve is trying to navigate this with precision, but the margin for error is razor thin. If inflation remains persistent, the Fed will struggle to cut rates. If the economy weakens and the Fed is forced to cut rates anyway, inflation could return. Either scenario creates pressure on the dollar. When the dollar weakens, the relative value of hard assets increases. Gold, oil, and commodities are priced globally. A weaker dollar means higher prices for these assets in dollar terms. This is not speculation. This is arithmetic. The Greenland situation matters because it represents another fiscal commitment at a time when the U.S. can least afford it. If the government pursues this path, it will require funding. That funding comes from either higher taxes, more borrowing, or monetary expansion. All three have inflationary consequences. Investors need to think about what their portfolios look like in an environment where the dollar's purchasing power declines steadily over time, because that is the most probable path forward. One of the hardest things for investors to do is act when conditions are uncertain. Human psychology craves clarity. We want to know what will happen before we make a decision, but markets don't work that way. The best opportunities come when uncertainty is high and most people are paralyzed. The worst decisions come when certainty is high and everyone is confident. Right now, we're in a period of uncertainty. Most people don't know what to make of the Greenland story. They don't know if inflation will return. They don't know if the dollar will weaken. They don't know if commodities will rally. That uncertainty is actually an advantage, because it means assets are not yet overpriced by consensus. It means there's still time to position thoughtfully. But it requires discipline. It requires the ability to ignore short-term noise and focus on long-term probabilities. It requires the emotional control to buy when others are hesitant and hold when others are panicking. This is what separates successful long-term investors from those who chase performance and end up losing money. It's not intelligence, it's temperament. Let's talk about something practical. How much of your portfolio should be allocated to assets that benefit from this environment? There's no universal answer. It depends on your age, income, risk tolerance, and financial goals. But here's a framework. If you're young and have decades until retirement, you can afford to take more risk. A higher allocation to commodities, resource stocks, and precious metals makes sense. You have time to ride out volatility and benefit from long-term trends. If you're near retirement or already retired, preservation of capital is more important. You still need inflation protection, but you can't afford to take excessive risk. A moderate allocation to real assets, combined with income-generating investments, is more appropriate. Position sizing matters just as much as asset selection. Owning gold is not a binary decision. You don't need to go all in or stay out entirely. A 5 to 15% allocation can provide meaningful protection without exposing you to catastrophic loss if the thesis doesn't play out. The same applies to individual stocks. If you want exposure to rare earth miners or defense contractors, don't bet the farm on one company. Diversify across multiple positions. Limit each position to a size where even a total loss wouldn't devastate your portfolio. Risk management is not about avoiding risk. It's about taking calculated risk in a way that allows you to stay in the game over the long term. Step back and look at the bigger picture. What's happening with Greenland is one data point in a much larger story. The story is this. The world is transitioning from a unipolar system dominated by the United States to a multipolar system where multiple powers compete for influence, resources, and economic control. This transition creates friction, it creates volatility, and it creates investment opportunities for those who understand what's happening. Countries will prioritize resource security over free trade. They will build redundant supply chains, even if it's less efficient. They will stockpile critical materials. They will invest in domestic production of energy, minerals, and technology. All of this is inflationary. All of this is bullish for physical assets. And all of this is a headwind for passive index-based investing that assumes the next decade will look like the last. The investors who do well in this environment will be those who recognize the shift, position accordingly, and have the patience to let the thesis play out over years, not months. No one can predict the exact sequence of events. We don't know if the U.S. will formally pursue a transaction with Denmark. We don't know how China and Russia will respond. We don't know how markets will react in the short term. But we can observe trends. We can assess probabilities. And we can prepare for a range of outcomes. And the most likely scenario is continued escalation of rhetoric and strategic positioning in the Arctic. Increased military presence, increased investment in infrastructure, increased competition for resources. This happens slowly, then suddenly. Most of the time, it's background noise. Then one day, something happens. A resource discovery, a military incident, a trade disruption, and the market reprices everything in a matter of days. Your job is to be positioned before that moment, not because you predicted it, but because you understood the probabilities and acted rationally. Let me bring this back to where we started. Something has changed. The conversation around Greenland is not a distraction. It's a symptom of deeper forces reshaping the global economy. Resource competition is intensifying. Fiscal pressures are mounting. Monetary systems are strained, and investors need to adapt. This doesn't mean abandoning everything you know about investing. It means expanding your framework. It means considering scenarios that seemed unlikely 5 years ago but are now increasingly probable. If you hold strategic assets, stay disciplined. Manage your risk, take profits when appropriate. And don't let greed override your judgment. If you don't hold strategic assets, ask yourself if your portfolio is prepared for a world where inflation persists, currencies weaken, and physical resources become more valuable. Above all, stay informed. Keep learning. And resist the urge to react emotionally to headlines. The investors who succeed over the next decade won't be the ones who panic or speculate wildly. They'll be the ones who think clearly, act deliberately, and understand that financial success comes from preparation, not prediction. Cycles turn, markets reprice. And those who understand the underlying forces always have an advantage over those who simply react to noise. Stay patient, stay thoughtful, and stay focused on what actually matters. Because in the end, that's what separates long-term wealth creation from short-term gambling. Thank you for your time and attention. I'll see you in the next one.